if you are not having a very good risk management strategy, then whatever you are doing here is basically gambling. And since what we are doing is not gambling, we had to emphasize on what is key. And key in the sense that if you have the best entries, best strategy to trade this forex or cryptocurrency or synthetic, and you have a very poor risk management, you just continue in a cycle. You will make profit and you will give it back to the market. So we face these things on a daily basis. And that's why we emphasize on risk management. Now, risk management involves a lot of things, which is discipline. Involves discipline, your choice of lot size, your choice of leverage. Leverage will say the amount of money the broker is giving you as loan to allow you to trade the market. Because without such leverage, you cannot competitively trade with banks, hedge funds, financial institutions that are responsible for export and import, where currencies exchange hands. And these things are being controlled by the central banks. They are sovereign currencies of countries that are being traded across the globe. And we say the broker is the one that gives you the platform to trade electronically. And today, if there is time, we will introduce us to the platform where this exchange happens electronically. Some of us, we don't want to assume that some of us know it all. We believe that there are those that don't know how trading happens. They've been hearing Forex. They know that it's foreign currency. When I heard Forex, I felt it was bush, bush with trees, forest. It took me time to understand it is Forex. So what really is Forex? It took me really study to understand that it's electronic exchange of currencies. And that is being done via a medium of a broker that takes little commission for giving you such platform. So today, I'll be introducing us to more deeper terminologies, to more deeper insight. And then even if you think you know, you may have to unlearn at a particular point. You may have to unlearn at a particular point to learn new skill. So without much of talking, as you can see what I'm sharing, I believe we are all seeing my screen. Forex trading strategies and models, free online training sponsored by Kani Legacy, anchored by myself, and arranged. Every material has been arranged by me. And I must also emphasize that I am not the source and the origin of some of the concepts here and images. They are available online. My responsibility is just to arrange them and then to give meaning to some of the images in an organized manner. So please, I want to know if we are all hearing my voice and seeing what I'm sharing. Can somebody just unmute and just let me know that I'm talking to people that are actually listening and hearing what I'm saying?
Yes, we can hear you, sir. We can hear you, sir.
Yes,
Are you
sir.
guys seeing my screen and hearing me clearly?
Yes.
Yes, I can hear you, sir.
All right, all right.
You can see it.
So please, I'll appreciate if you mute yourself and pay attention. We're 11 a number, and whoever is not here may have to watch the recording because I have to edit the recording and take out what is not important for public, the global public. So, without much story, let's start. Father, we thank you for today. We thank you for your grace. We thank you for the impartation of knowledge. We commit this session to your care and to your power. And we ask that, Lord, the essence for this class will be achieved. Every distraction be blotted out, and let your people come to the full realizations of why they are here and why they have been chosen for this free online class. Lord, the resources to take it further, we ask that as we commit to these tutorials, let the resources enter our hands and teach us discipline. And let this skill be the basics and the foundation for greater achievement. In Jesus' name we pray. Can I hear somebody say amen?
Amen.
Amen.
All right, you people's voices deep inside. I'm not hearing you guys clear. Maybe it's from my own side. I need to increase the volume. Can you guys say amen? Let me know that you guys are hearing me.
Amen.
Okay.
Amen.
Amen.
Okay, I wasn't hearing. I have to increase the volume of my laptop to hear you guys. So people are joining. We are 15 in number now. All right. Today I'll be talking about strategies and models and a lot of things, strategies. Based on our calendar today, I'll be talking about, I posted the calendar for each day, support and resistance, so demand and supply. But before we get to that point of demand and supply, so please mute yourself. Dixon, please mute yourself. Thank you. I know you didn't know. He was surprised. All right. Before I go into details about demand, supply, which is support and resistance, you need to know, just as I said, we don't want to assume that you know anything. We are taking you from the elementary, which are the things I did yesterday. And my apologies to those that have passed this level. Just be patient with us. We'll get to the point that will become very interesting to those that have gone past this level. Today, I want to introduce you to what we call candlesticks. Candlesticks is a measure of price in the market. How we measure price movement in the market with images or an illustration. And that illustration is captured, or that price is captured with this image, electronic image. And this image is printed on a platform, and the platform is called MT5. So you'll be seeing this image in different shape and sizes in the electronic platform. So what is the meaning of these images? You can see a lime color. You can give it any color and red, but this is the most popular. You can give it any color. You can actually change this color, but just know what the color means. That is a color that is lime. That is a color that is this red. For the purpose of this tutorial, I will use these colors. And each of these candles, the whole of this image is called a candle. It has a wick up, it has a wick down, and it has a body. This body is called the candlestick body, and this part is called the wick. The same thing here. And each of these candle has a low and has a high. So when you see this candle, it means that you will see the candle means bullish, market is going up. And when you see this candle, it's telling you that the market is coming down. What it means by market price, when I mean market, I actually mean price. The price is of a particular asset is actually going up. It's represented with a bullish candle, or you hear the word long. When we say long, bullish candle. When we hear short, it means bearish candle. And these are the graphical representation of price depicted, printed with this image. So each of these candles has an open price and a closed price, has a high price, has a low price. For every commodity, it has the lowest for that day, it has an open, it has a close, and it has a high. It's like going to buy a bag of rice. We say today, bag of rice, we started the market today, we opened the market today with a particular price. Let's say it started with 50,000 naira a bag of rice, but at a point it came low to maybe 45,000 naira. And then at a particular point, the price of rice went up all the way to maybe 60,000. And then as the market is closing in the night, people started selling it at a close price lower than the highest price, which is this. But the close price is still higher than the lowest price. The close price maybe went up to 60,000 and closed at 57,000 naira per bag. So you see that there are four prices: the low price, the open price, the close price, and the high price. So the market will say it has a high, but it closed at this particular point. So probably you bought at this price, then you sold at the open price. Or you bought at the open price, then you sold at the low price. You thought that the price would go lower to maybe 30,000 naira. It opened at 50,000, you thought that it would go to 30,000 naira and bought. The lowest it stopped was 45,000. So you were scared at 45,000, so you sold here. So that means you have lost, even though the market ended up high, but you lost at this point, So that's why you can see that market went high, people made money, but you lost. Why? Because you were scared that the market will go lower from the open price of 50,000 naira to low of maybe you were scared that it will go to 30,000 naira. Maybe probably last week it was 30,000 naira. So you were scared that it would go to 30,000 naira, but the lowest it stopped at was 45,000. I'm using the rice as an example because we'll be trading on a lot of assets: gold, cryptocurrency, dollar, euro, pound. So I am using what we can relate with in our culture, in our environment, to understand that it's the same principle that applies in this graphical representation when we begin to talk about Forex trading. So I just use this to explain this bullish candle. Now, the same thing here, when the market is coming down, it's possible this market went high and then you actually sold at a good price, right? You bought at this low. When you got to this point, this is where you sold. You sold it here at this high price. Let's say this same price where the market closed, it will open. The market opened at where it closed. I said here it went high at 60,000 and then came close at this price, because I'm taking time to explain this because some people usually get confused. So that's why I'm explaining this candlesticks. And then it closed there. Where it closed is where the next candle will open. Where this bullish candle closed, that is where the next candle will open. When it does not open where this price closed, it leaves what we call volume void, price void. There is a void in the market. Void in the sense that nothing happened there, and that void must be closed. That void will be closed. That is what we call price void. That's what we call price gap. These are technical terms which we use to make money. So I've not gotten to that. Remember this statement I'm making because it will make reference to this a lot. Now, where the price closed, the next candle will open there. Is always, if this market closed at 57,000, this candle will open at 57,000 naira. I'm using rice as an example, as a reference point. We are not trading rice here, but there are people that trade corn. Everything is tradable there. That is corn, that is rice, that is beans, there's soybeans. As far as your broker provides it, you can trade these things electronically. So even though I'm using rice, yes, you can find that it might not be used as rice. Maybe say soya beans, maybe wheat. So I'm just giving us an example with rice as a reference. So let's say this bag of rice closed at 57,000, opened at 57,000 here, then went all the way. The high here, let's say it was 60,000, but it went all the way to 60, went all the way here to 60 something thousand. Let's say 65,000. Wow. When you got there, you say, wow, you have made profit. You have analyzed the market that this 67,000, this market will come down to maybe 40,000. The low here, let's say it was 45,000. You have analyzed the market. This is a good high. Amaka, please. You want to please mute yourself. So we got a high, let's say 67,000, and then you have predicted, analyze the market, that the market will come low to maybe 40,000. So what you just did was you sold at 67,000. You bought when the market opened at 57, you went high and just jump out of the market. And then the market started going down, started going down, started going down. You are no longer in the market. Now, what I'm explaining is called spot trading. You have jumped out of the market. But when it comes futures, you can also enter the reverse and predict that the market will come down to 40,000. So you bought the asset at this. It's not buying, actually. You are selling, you are predicting that the market will drop down and the broker will reward you for taking a position that aligns with price movement. So as the market is dropping, you are making money. You are making money. That is where I introduce us to what we call pips. The movement from here to here could give maybe 100 pips. And for each 100 pips, which you have predicted, you're actually making based on the value of the pip you choose, which is the lot size, will determine how much profit you make. But if it is spot trading, you're actually not futures. Futures is when you calculate pip. When the market is coming down, you're making profit. But when it is spot is either you are in or out. So if you are out, that means that you have booked your $67,000 profit here, and you step out. If it is 10 bags of rice you bought, you look at the profit, 57,000. You entered 57,000. You sold at 67,000. So you make 10,000 naira for 10 bags. So you calculate 10 bags times 10,000. You have made 100,000 naira. So that is how you jump out. That is spot trading. But if it's futures, you calculate based on pips or based on contracts. Let me not confuse us with that. Just understand that you make profit. So on spot, when you are out at a good price, you buy lower, you sell at a good price. When the price comes down, it will close lower. And then the person that thought that the market will keep on going up.
Yes, please.
The person that thought the market will keep on going up will begin to lose. Because you didn't predict the market properly. And then the market closed lower. This is where you bought at the close of this candle. Look at the close of this candle, lower. So you have lost money. But does that mean that is all? No. The market, another of this candle can start forming again and close higher. So it's all about analysis, and that is where you are here to be trained on how to analyze the market and make profit from it. So now to tell us candle patterns, because the market is not just one candle we'll be seeing. This candle can represent 1 minute, can represent 1 second. Each of this candle can represent what happened within 1 second, 1 minute, 5 minutes, all the way up to 1 month. The whole of this candle can represent what happened in a month, can represent what happened in a week, can represent what happened a whole day, can represent what happened in 4 hours, in 1 hour, in 30 minutes, in 15 minutes, in 5 minutes, in 10 minutes, in 2 minutes. It's just you choose the time frame you want, and then decide whatever time frame that's applicable to this is what is applicable to this, because both these two candles are always represented in a chart. But you can see continuation of this candle printing themselves over and over and over and over. Then you now see this type. We can see this one, then see this one follow down, but not down to this level. They are not at the same level. You may see this one at the top here, but it closed lower. We can see it up, but you can see many of these. Then you can see one among many of this candle. So just understand that it's not just, and I'll give us an example in the next slide. You can see it here. You can see there's a bullish candle, there's another bearish candle, there's another bearish candle. This one is shorter than this. So the shape of this candle or the height of it speaks volume. The length of the wick, just as you are seeing in this place, you can see this is called the wick. The lower shadow, these are wick. This line you are seeing at the top here, this line you are seeing at the top here, they are called wick. So I want us to understand that. This week, we use it to trade. We use it for analysis. Everything you are seeing here is very important. Nothing is useless here. This week you are seeing, these candles you are seeing. So You can see the wicks here too, and the shape of this candle. Now, these candle patterns, when you see this 3-pattern candle, we call it evening star. When you see this candle like this, we call it bullish star. This one is telling you the market is about to revise. The price of a commodity or an asset is about to begin to go down. So if you are in the market and this formation comes up, probably you bought, and the price came. You brought lower and the market came down, and then at the top of a price range of candles, many candles, let's say bullish, market started from bottom and went all the way. And we started seeing this at the peak of the price of an asset. It's telling you that it's time for you to exit, come out with your profit. The same thing here. If the market has been coming down to this point, it's telling you it's a time for you. If you want to buy that asset, buy it, because the market is about to start going up. So at this point, we exit what we have bought lower and we sell at a profit. At this point, we buy something that is lower that we expect that is going to go up. So at this point, it's time to come inside the market. This one too is time to come into the market if you think that the market will come down. So if you predict the market will come down, you predict it, you get rewarded for predicting that the market is coming down, and you earn a number of pips relational to the distance covered. The number of pips is relational or proportional to the distance covered from a high point to a lower point, or from a lower point to a higher point, represented by what we call pips. We spoke about pips yesterday. So you have the evening star, you have the morning star. The evening star shows you a reversal. Both of them is reversal. So always see that when you see this red, if you give it red color, but just know that give definition to a red color. Me, I have given this red color a definition that market, right, a bullish pattern, where market has been coming down and the market is reversing now, signified by this bullish candle. Or market has been going up, signified by this bullish candle, and then market is about to start coming down, signified by this bearish candle. So you can give your bearish candle any color of your choice. In my other class, when we spoke about synthetic, we spoke about the psychology of colors, why we choose not to use red. Red speaks of alert, speaks of danger, and it is not right psychologically in financial space. It speaks of danger and it speaks of risk. So we try to avoid red color in our chart. So if you have been following my tutorial, my mentorship, you will notice that I avoid red color completely, except the one I cannot change on the platform. So I'm just adding that as a bonus. So I'm just showing those candle patterns. Here's another type here again. This is another type of candle pattern. This is called bearish engulfing pattern. When the market has been going up, signified by this bullish candle, then suddenly I see a long drop in price. It's telling me that the market is about to go more lower. So what am I supposed to do? If I'm holding that particular asset, it's time for me to jump out. Or if I'm about to enter the market and I'm seeing that it's telling, sorry for that break in transmission. So can you hear me all? Are you guys hearing me, please?
Very well.
Hear you.
All right. Thank you. I'm clear, right? I'm clear enough, right?
Yes, sir.
All right. So this is
Yes.
the bullish. This is the bullish engulfing pattern.
Yes, sir.
This is the bearish engulfing pattern. It tells you that if you're about to enter the market, know that if you're entering the market, you are entering to predict that the market is coming downward. So you leverage on the bearish move, which is a downward move, and you make money. It's telling you the market is about to sell. Market is about to sell. If it is spot trading, it's telling you that if you are holding anything, sell it, because that thing is going to fall in price. The value of that thing is going to fall, so you sell it. That's spot trading. But the forex trading is not spot. If you take any direction, it's either you're predicting market up or you're predicting market down. You make money based on the prediction. If you predict wrongly, you lose. So analyze the market and then take position based on the direction we think a particular asset is about to go.
So the same thing with the bullish. The bullish pattern signifies strong buying motives, best traded in an uptrend. So we begin to ask, what is uptrend? It's something that is trending upward. If we know that Naira from 2 or 3 years ago has been trending downward, Naira has been losing value. What it means is that dollar has been trending upward. So if one is trending up, it means that the other one is trending down. And so if you have been holding Naira, you find that the value of a Naira has depreciated because dollar has been trending upward while Naira has been trending downward. And so if we look at the chart of Naira to dollar, we see a bearish engulfing pattern from 2 or 3 years ago. And then if you're holding Naira, what we are supposed to do is to swap your Naira for dollar immediately with this pattern. And then what it means that Naira will be losing value, your dollar would have been losing value. And so your dollar would have been gaining value because dollar would have shown, if you look at dollar chart, you see that dollar is showing this sign, telling you that dollar is about to begin to gain value. Looking at dollar gaining value, you now buy dollar. You convert your Naira to dollar. And this will be happening. Then when we see this in a chart, what it shows, what it means is that there is indecision. It's called tweezer, tops bottom. Some people call it crosses. It talks about indecision. The market makers, the people that determine movement of market, they can move market. Just a peep in the market, I heard that it costs nothing less than $1 billion to move just a peep. So the people that move this peep are called the market makers, central banks, hedge fund, and other massive financial institutions. They're the one that move the market. So when they have not decided direction of the market, probably they are looking at which direction. Like for example, what is happening in America now? They can say Trump now is hitting tariffs to Europe, to like Euro and US now. Now they are negotiating. You could find this kind of candle patterns telling you that we don't know the direction the market is going. And so everybody is waiting to take a position. Because if you take a wrong position before understanding the direction of the market, the loss will be massive. Because if the market is going up and you decide to go down, you'll be losing. So it's either you jump out quickly or you lose big time. You could lose to a level that you don't have a margin again based on the leverage I spoke about yesterday. If you have a very big leverage and you choose a big lot size, the market, and you predict the market wrongly, the broker will not lose money. It's your money that you will lose. The fact that he loans you money does not mean that he's losing money. He has placed a margin to which, if it happens, anything happens, you're out of the market. So when you see this kind of candles, you don't jump into the market. You just wait. Patience is key to profitability in trading. So support and resistance. What is support and resistance? Support and resistance shows you the lowest of a particular asset and the highest, represented like this. I am showing us the theory because when we enter either today or by tomorrow, we'll only make reference to this and show us practical. We'll be into practical. So you are expected to know these things because from tomorrow and next, you won't be seeing these slides again. If I may make reference to the slides, but 90% of our trading will be in the market because it is not theory that gives you money. Theory gives you a foundation for you to practice, and it is in the practice that you make money. So support and resistance. Support is an area of price where the market will go lower, which is this, and it's also called demand and supply. So if you see the word demand, it's actually telling you the support, and supply the resistance. So you can see an area of price where the market will go lower. Resistance is an area of price where the market will go higher. So you can see when we see resistance, we usually draw straight lines to show resistance points and support lines. So support and resistance is usually accompanied with market reversal. So you can see market, we expect that there was a previous resistance that market came down from and hit a support. So we usually draw a straight line into the future with the expectation that when we are predicting the market from this resistance, we expect market to come down to the support region, which is here. And this what I'm teaching here is applicable across all types of trading, whether you are trading synthetic indices, whether you are trading stock, whether you are trading cryptocurrency, whether you are trading Forex. Whatever we are learning here is applicable here, particularly when it comes to support and resistance. Now, what is trend line? Trend line tells you an overall movement of the market in one direction, whether it is uptrend or downtrend. That is uptrend, that is downtrend, right? This moment from this point here to this point is a downtrend. From this point to this point is a downtrend. So in an uptrend, you can also see downtrend, but the overall movement is an uptrend. So to really see the overall market movement, you use the higher time frame. But on a lower time frame, somebody was asking me yesterday that when she goes to lower time frame, she see downtrend. But she goes to higher time frame, she see this movement. I say yes. Why? Because we trade according to the trend line. And that's why it is said the trend is your friend. But while we know that the overall trend is upward, we also leverage on intermediate short movement of downtrend like this. So you draw a line that connects the overall movement so that when you are taking a entry from this point, you know that when you get to this point, you should exit. So basically, this point is resistance and this point is your support. So you can see in a trend line, you capture resistance and support, just like you have here. You see this resistance, you see support. You also find it in a trend line. The trend line tells you the overall movement of the market. So when the market moves up to, it's moving like this. So you just know that there is a resistance here. There is a support here. So when you take here, you exit at this point, and then you rebuy because you know that this trend line is your support. This point is your resistance. This trend line going all onto the future is your support. Because why? The market is going up. If the market is coming down, so you just know that the trend line will come this way, will come downward like this. So automatically that trend line is your resistance. But for this, when the market is going up, the trend line is your support. When the market is coming down, the trend line is your resistance. So in this point, you take it here, go up, and then you exit. We'll explain to you when you take out this point, you exit. Now you know this is your resistance. When you buy at this support, this trend line support, we expect you to exit at this previous resistance. And then when the market comes down, again goes up at a particular point, will explain to us why we should pick trade at particular zones. Then you take, and then you can see that this market is ranging. It's not clear like this one is drop sharp, clean trend line downward. This one is not a clean one. So this is like a ranging market. These are the kind of market that people loses money. So you avoid this kind of market and you wait for the market to come to your support zone. You buy from this point. And then you go up, you know that this point now is your resistance level. Now, I have not actually taught this in our synthetic class. And that's why I told those in our elite group that it's good to come here because I'll be teaching things that I have not taught in our synthetic class. And in this Saturday in our elite group, I think I will concentrate on, I will add this to what we already know, the trend line analysis and how to leverage on trend line to trade synthetics. So this is another strategy you can deploy and you make good money. Just trend line and moving averages. I will show us how to trade trend line and moving average. I have not taught that in our previous class. And as I told us that join this class, you will learn something that you add up to the already knowledge you have. So I hope we are understanding what I'm teaching, please. I hope I'm not talking to myself. Are we understanding me? Is my teaching clear enough?
Yes, sir. Yes, sir.
All right. So
Yes, sir.
Yes.
I want to know if I'm making sense or not making sense at all. So very, very important. So the next thing I want us to talk about is swing points. Now, everything is connected. Trading is connected. Do you remember I told us this support and resistance level? They are also called swing points. This is a swing point. 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 So there are people that only trade swing point by swing point. When you trade from this point to this point, you are a swing point trader. When you trade from this point to this point, you are a swing trade trader. From this point to this point is a swing trade. In fact, from this point to this point is a swing trade. From this place to this place is a swing. From this place to this place is a swing, and this place is a swing. A position trader is a person that pick his price from this place and it's not coming out to this point. This person position himself, and this is the work of fundamentals, people that trade based on news. They already know that Trump will come with his tariff plan, and because of that, dollar may lose value. So they take a position of buying euro, and then they bought euro from this point, and they are holding till the point that euro and US agree at a price point. So I will explain to us what I just mean here, and you see how you have actually been going upward since when Trump took office. So position traders will follow fundamentals, follow news, geopolitical news. I spoke to us about it yesterday. New policy, central bank interest rate, GDP, crisis, earthquake, war can affect currencies. And position traders knows how to explain this. And we are so privileged to have our coordinator who is an expert in fundamental analysis, and he will be taking us through fundamentals when the time is due, and he explained to us how to be position traders to understand that market is uptrend and you only take a position. Position traders can take trade here, can take trade here. They only take trade that is bullish because based on the fundamental news, you know the market is up. So what is swing point? Swing forms the low and the high, just what I just explained earlier. Please mute yourself. Mute yourself. It forms the low and the high. Lows and high are formed with common factor called as swings or swing points. Swing points are known as three candle structure or pattern. Price leg starts with a swing and ends with a swing. For bullish swing low to swing high. How the swing gets formed? Now, this is the three candle patterns that those of us that have been in the previous class and in Allied school knows very well. And I told some of them that they should join this class because I'll be a bit more detailed. The swing forms after the first candle high or low gets swept. Now this is your swing. You see the first candle, you see the second candle, and you see the third candle. Now we look at this 1, 2, 3 candle patterns. Now this is an advanced bullish engulfing pattern. I told us the 3 candle bullish engulfing pattern. It has a name for it, and I don't want to go further than that for now because our class is supposed to be 1 hour. I want to stop at support and resistance, but you won't understand the support and resistance very well. That is why I brought the trend line to introduce how you can pick support and resistance even in a trend line, and how you pick support and resistance in swing points. Swing points is another stylish name for support and resistance. Low and high, support and resistance, demand and supply is all saying the same thing. But that's the way these swing points form when you're actually looking at just 3 candles, not the range of many candles the way you have here. You have many candles forming high and support swing points. What about you are just looking at 3 candles? Something like this. This is where swing points comes into play. We look at the first candle, we look at the second candle, we look at the third candle. The second candle must break the support. Now look at this candle. I told us about the wick. Look at the wick here, where this number 1 is. I told us that you must take this wick seriously. You see where the wick is played here in interpretation of price. This wick you are saying is not just there for fashion. It has a meaning. And I told us now look at where we are applying this wick now. You see this wick. Now we pick this candle, this bearish candle. We'll look at this candle and we'll look at this candle. Now this wick break the low of this wick and we'll draw a straight line. This is now your support. The top of this candle is your resistance. The top of this candle is your resistance, The low of this candle, whether that is weak or not, but if that is weak, fine. The low of this candle is your support. So we'll look at this week, break the support, but the body of the candle is above this line. When we have something like this, and this candle confirms it, it's telling you that, well, market is about to go up, which confirms this candle pattern I show us is called the morning star. This is the morning star. Now, the opposite of that is called the evening star. If you have the opposite of this, is called the evening star. It's reversal. So these three candle patterns give us a swing operation. It can be a range of candles. It can just be just three candles. When and where does the swing get formed? A swing gets formed on a key time and a key level, which makes it more probability. Makes it high, more probability. Now, I don't want to go deeper. From tomorrow, we'll begin to explain this deeper because some of us will begin to, I'm going more deeper now because market structure shows us, I actually come down because what I'm showing us here now is more of an advanced trading. This alone, we can end this class. Somebody that grabs this alone, you don't need anything again. I just want to tell us the truth. But because this is a preliminary beginners class, we'll practice this to see it play out live. I can tell you that I learned these things after 10 years in this. I've been trading it without knowing it, but I understood this very well as a model of trading. And I have seen consistency in my trading. It's not enough to understand this secret I'm showing us. Without discipline and good money management, whatever I'm teaching you here, whether I release and give you the holy grail of trading, you will still lose money. If you lack discipline, if you lack restraint, if you lack good financial management, because I don't have much time, we'll be practicing this maybe from tomorrow or next. But you are reading what is on your face here. Price at a key time and a key level is very powerful. Key time and key level. There are levels we call sessions. Market is divided into 3 sessions. More than 3 sessions, that actually 5. We have Australia, we have the Asians, that's Australia, the Sydney session, we have the Asian session, we have the London session, we have the New York session, actually 4. You have the Sydney, where you have the Australia, the New Zealand, and then you have the Asian session where you trade Japanese yen and anything connected to the Asians. Then you have the London session where you talk about the European currencies. You talk about Swiss franc, you talk about British pounds, you talk about euro. Then the New York, definitely. You talk about United States dollars, which is paired with almost every currency. But the session that has the high liquidity is the London session. So those are the sessions now. These are where we talk about sessions, kill zones, opening time when the market opens. It's called key time. I will show you this practical when we start practical. So just have this key time. I will still make reference to this slide. I'm just establishing foundation. We'll be making reference to this slide while we are practicing. I'll be making reference to this slide. Then we have the key level. Now, I will explain to us what PD array, where the market is divided into 2. The support area and the resistance area is levels. We separate it into 2 levels. There is level called the premium level, is a resistance level, and this area we call the discount level, is a support level. So we actually buy from the discount level and sell at the premium level, or you sell at the premium level, you predict from the premium level to the discount level, and you aim your profit in pips. And there's what we call the fair value gap, where I told us that when this market opened, I explained to us something here, that when this market where this market closed, and instead of this one to open at the same price, it opened somewhere else, or where you have another bullish candle forms without any corresponding bearish candle. Because when you offer a buy, you're supposed to get a sell. When you're selling something, you're supposed to get a buyer. So when you get the buyer's offering price and there is no sell, the broker, the market makers took it high again without a corresponding sell. Market keeps on going up without a corresponding sell. It forms what we call fair price. There's a gap in price delivery. There's an imbalance in the market. These are advanced technology price reading. So I'll be explaining this. So when such kind of things happen, they call it fair value gap. This thing you are seeing here drawn at the bottom of this resistance, this candle, now this 3-pattern candle, came to where we have a key level. And this key level is the discount level, where there is a fair value gap. And when this happens, market will always shoot up. Just at this point, I don't even wait for this to form. The whole of this is a major confirmation. But when I see just these two candles form like this, I just enter at the close of this bullish candle. And everything that happens here is to my profit. Some of us will take this as just a simple talk. I just gave us a golden key here. But you will not understand this until you start going, practice it over and over and over. It will not stick to your head. Now, these are samples of the sessions I spoke about. Now, the 3 sessions we bother ourselves about. Most of us don't trade the Sydney session because that means that in our time here, you have to stay awake to trade from maybe 11 o'clock to around 2, 3. No, some people do that. So this is our timing here. I will be telling us about time alignment. We'll talk about Asia, London, and New York. And we'll actually look at this time. This is 18 o'clock, our time. So we look about 18 o'clock, 6 o'clock, our time, GMT +1. 22 o'clock talks about London. Now, if you see 14 here, we talk about 14 is that's around 2 o'clock, Asian session. Now, this key level, 18 o'clock, is taking about 6 in the morning. Now, I'll be showing us this time alignment, how you can know Eastern time and GMT, because the global trading, Forex trading is usually done in correspondence to what we call Eastern time, New York time, which is most times 6 hours, at times 5 hours ahead of our time. So I will explain to us what this 14, 18, 22, what it means is our timing. This here is 2 a.m. New York time. This 2 a.m. New York time and 6 a.m. Now, you can see that is a little blue color here. These are key level. We actually look at price reaction at key level. Key level means at a particular time and at a particular fair value gap. Where there is a gap in the market, I will explain to us. Don't worry what this fair value gap is. Just keep it. I spoke about fair value gap and sessions. And so we look at a key level at a particular time. What happens at a key level? What happens at a particular time? Market moved at a particular time. Market moves at a particular time. This 2 a.m. here is in our time is 7 a.m. New York time. New York time 2 a.m. means 7 a.m. our time. Then 4 hours to this 6 a.m. here is telling a key level. So add 4 hours to your 7 o'clock, that's around 11 or 12 o'clock our time. We want to see price react like this around this time. When we see these two candles, this one is profit, this one is profit, this one is profit. So the reverse is the case. Well, we're going to go into practical class. It will begin to make sense to you. And this is something that you cannot just learn just in 5 minutes, but just store this in your head that we trade at a particular key level and a particular time. Tomorrow, I'll be talking about market structure. what market structure means. This can be a bit difficult for some people to assimilate it. But tomorrow I'll come up with a slide, and that slide I will introduce us to Asia, London, and New York, how to interpret or how to translate or interpret New York time to our time, how to convert New York time to our time, and how to allow it to reflect in your chart. The broker will have a different time, while New York time is different and your own time is different. So you have to reconcile the three different time zones: the broker time zone, New York time zone, and your own time zone, so that it aligns with the key level, and the key level we work with is New York key time, New York time. So you must find how your time aligns with New York time, how the broker time aligns with New York time, and then we'll find the key level. The key level is not just about time, it's about price gap, where there was buyers and there was no sellers, where there were sellers and there were no buyers. Those are the areas we call key level. Key level also can also be support level or resistance level on a high time frame, while you are looking at this at a lower time frame. And you saw the formation of the three candle pattern in an Asian session. If you are trading Asian session, most time we're actually trading London and New York session. And our London session, most time we begin the trading around 8 a.m. in the morning. That's when London opens. London market open around 8 in the morning. New York opens around 2 or 1:30 in the afternoon, our time. But this timing and this timing, I will tell us what it means when we begin to move forward. From tomorrow, we'll begin to relate this to our chart, and we'll begin to see how this thing plays out on our chart, and I'll give us tools that we use to show us this, and indicators, premium indicators that I have that helps print this thing on my chart. I don't begin to do calculation and bother myself. I just go, I just know when these things, it just prints automatically on my chart, and I leverage on it. I will need to stop here. All right, and I explained to us that we only consider that formation, or most times those formations usually happen at a key level and a particular time. At a key level at a particular time, the market would accumulate, manipulate, and then expand. We enter from the expansion level. All this is trying to accumulate. Market makers are trying to accumulate orders. Then they manipulate direction. They tell the market is going down. Look at this movement now. And you think the market is going down. This market you are seeing was actually black, going down. Then all of a sudden, return back and close upward. And you that thought the market will keep on going down, now you're at a loss, because instead of you to jump out, you didn't. Market now reversed and closed like this. Now we wait. That's why you have to be patient and wait for these three candle formation to form before you jump in. Can we enter from here? I can explain to us how to enter from here, but it's not the best practice. This tests your patience. Patience, particularly when you're trading on a higher time frame, and we enter like this. Now I'll be explaining to us this as we progress. This as we progress. Any last question, please?
Yes, hello, sir. Okay, can I go on?
Please go on.
Okay, good evening, sir. Thank you so very much, Mr. Elijah. So
Yes.
I wanted to why explaining the forest this candlestick at the same time, I was trying to like corroborate it to synthetic. So I want like which one is more volatile for these two, trading synthetic and forest. Which one is more hard, more risk?
Synthetic forex is volatile during news time. Only when there are geopolitical news. News could be central bank interest rates, could be CPI reading, could be some announcements, could be war, could be like tariff. So you can make the market volatile at those timing. So avoid those timing. And then when the market is opening during the sessions, it can be a bit volatile. Synthetic is extremely volatile. Not all the synthetics FS volume can be volatile, but volatility, when positioned very well, makes you more money when you understand the market. It gives you fast and quick money, and it can also make you lose fast. So I can tell you, synthetic there is no news that guides synthetic. It's pure price algorithm, understanding market structure and trading with it. There's no manipulation of news there. But whether this kind of manipulation happens there, yes, this is pure price manipulation. This thing I'm showing us is what some people are using to make huge amounts of money. Huge amounts of money. I actually said that's the last question, except but I had like two people were talking. I will give that one person the last opportunity. Because like two of you are trying to ask questions at the same time. Who was that person?
Yes, I thank you for the opportunity.
Okay, Stephen, you're welcome.
Thank you. So I was looking at this 3 candle pattern, and I wanted to ask that at what time frame do we use when we want to use the 3 candle pattern for our trade?
From any of the time frame, higher time frame, 1 hour, 4 hours daily, and then any of the time high time frame starts from 4 hours, 1 hour, 1 hour, 4 hours daily, weekly, monthly. So if I'm looking on 4 hours, I may wait for these 4 hours to finish forming, then this one, then I enter from the next 4 hours. As the next 4 hours is forming. So will you be patient for 4 hours? That is the question. This is where patience is being tested. If you are just watching this and you feel that I have known the secret and you go away, you still come back and look for me. There is much more to this than this. This is just the first key. But how to unlock the secret is another thing you must also be patient to learn. I will be stopping here because the class is not ending here today. This is just the beginning of the interesting journey you cannot afford to miss. By the time we are done with this class, I think you should be an expert in trading. Because I told you, it took me 10 years to learn this. From people that just started learning 2 or 3 or 4, 5 years ago. I became their student. And I was blown away by what has been there for donkey of years. There are more to release, just one among the things I know. But I feel that I have been teaching this to my students in synthetic. The 3 candle pattern, they are now knowing it in a different direction in Forex. And that was why I told some of them they cannot afford to miss this class. I'll be stopping.